Hello and welcome to our bi-weekly Understanding Markets video update. We are recording this on the afternoon of Tuesday, the 17th of May. I'm Hellen Dalton, a Senior Investment Manager with Cantor Fitzgerald, and I am joined again today by our Chief Investment Officer, David Beaton.
Hello, Helen.
Hi, David. So we're seeing some signs of moderation on market volatility, I think.
Yeah, I wouldn't say we're totally clear of the dangers that are lurking out there still, and we'll touch on them in a moment. But certainly over the course of the last week or two, we've seen some indications of some sort of moderation in the level of overall market volatility. Clearly, at the beginning of May, we saw significant pullbacks in a lot of the growth areas of the market, like technology, and that was really fueled by a big move higher in global bond yields. Now, over the course of the last week or so, we've seen bond yields stabilize and actually come down from very elevated levels. By way of example, the US 10-year yield went to as high as a yield of 3.14, 3.15%, and we're back down now around about 2.9%. Now, that doesn't sound like an awful lot, but it is a substantial move in yield terms in a short period of time, and it's also taken some of the selling pressure off some of those growth areas of the market. Similarly, in Europe, we saw the German Bund, that's the German 10-year yield, move up to about 1.15%, and we're trading back down around about 98 basis points this afternoon. So that's taken a bit of pressure off markets, equity markets, as I say, in relation to the wave of selling that we had seen. Part of the reason for the move lower in yields has come from the Federal Reserve. Regular listeners or viewers of this video will have heard us speak about how aggressive the Fed had indicated they were going to be in relation to their pace of interest rate increases. And the market got spooked by comments from one Fed member, the St. Louis Fed President James Bullard, who even floated the idea of a 75 basis point increase at an upcoming meeting. So what's happened in the last week is that Fed Chair Jerome Powell has basically taken that potential off the table by saying that it wasn't actively being considered by the FOMC, and that while they would move to increase interest rates by 50 basis points at the upcoming June and July meetings, they were then going to assess the incoming data and could equally slow down the pace of rate increases if the data warranted it. So that gave the market a little bit of comfort that the Fed wasn't on this set path of aggressive rate increases. We are still going to see rates substantially higher from where they are now by the end of the year, but I think the pace of the rate of increases may not be as aggressive as some market commentators had feared.
Yes, indeed. And you hinted a little bit there that we might not be quite out of the woods yet, that some risks might remain.
Some risks do remain. Obviously, inflation continues to be the main focus for markets and for central bank policy, both in the US, in Europe, in the UK, and globally. And that's really been driven by the increase in commodity prices, particularly oil. Oil continues to remain at quite elevated levels. Now, it's well off the highs it hit of $139 post the immediate Russian invasion of Ukraine back at the end of February. We did drift back to about $100 per barrel. We're up around about $115 per barrel, and that's potentially going to put some downward pressure on consumer spending as the impact of higher prices of oil at the petrol pump and also higher energy costs maybe impact some discretionary spend amongst consumers. Although, having said that, we did see retail sales come out at lunchtime from the US today, and they came in much better than expected. So probably some optimism there that maybe the consumer is in a better position to cushion these higher energy costs and other inflationary costs than maybe the market had anticipated.
Yeah, that news just came out just before we started recording this, and I think we also got some fairly positive news from the likes of Home Depot, which reads through quite nicely for the consumer in the US.
We did indeed. Home Depot's results were very strong. We've basically finished the reporting season for the second quarter. The last group of, or the last sector typically to report in the US are the retailers. We saw Home Depot come in and significantly beat estimates. Walmart came in and missed estimates, but it was for kind of reasons of absorbing the higher costs of goods and trying to keep volumes up. So probably not fair to react too negatively to the Walmart headline earnings that will probably hit the wires later today and be in the papers tomorrow. So overall, markets, taking some optimism out of these type of data. I suppose just a couple of other points that makes us feel more comfortable about looking at markets down around these levels. Market valuations have come back quite a bit. The S&P 8 or 9 months ago was trading on a multiple of over 20 times. It's now back down to 16 times. And that's despite the fact that the second quarter reporting season actually saw a higher level of earnings growth than had been anticipated. And full year earnings growth forecasts are still in around about, for 2022 that is, are still in around about 10% growth. So we haven't seen any significant downgrades of earnings yet. So valuations looking that little bit more attractive. There are, apart from the energy side of things, there are a number of areas still, obviously, that are being watched by markets. Obviously, the geopolitical situation in Ukraine hasn't improved at all, so we still have the knock-on effect of what that might do to European growth. And we saw the EU Commission downgrade its growth forecast for Europe yesterday. We also have bit of weakness in Chinese data, which is something that just needs to be kept an eye on because of the zero COVID policy there. Big fall in retail sales. So still certain things to keep an eye on, but net, we're probably looking at markets in a slightly more positive tone than they would have been the last time I did this about a month ago. I know Pierce from our colleagues in Marion did this 2 weeks ago, but certainly from my perspective, markets have bounced a bit from their lows by about 5 or 6%. Bond yields, as I say, have come back down a bit. Fed slightly less hawkish than they had been. Volatility kind of easing somewhat. We've seen a bit of a flush out in a lot of the retail stocks like ARC Innovation Fund, Peloton, some of those stocks down almost 80% from their 52-week high, where there was a lot of fast money in there. And even the likes of cryptocurrencies, they've all taken a bad hit over the course of the last week, which had a knock-on effect in the earlier part of May to broader markets. And that again seems to have kind of stabilized to a certain extent.
Thanks. And flying a little bit closer to home, we had Ryanair results yesterday. We heard from the management team. They gave a Cantor presentation this morning. Any just quick comments there?
Yeah, I mean, Ryanair's, and I liked the pun at the start of that, by the way. The Ryanair figures yesterday, and as you say, we had a call with management. Market reacted a bit lukewarm to them. They actually beat on their loss per share. They had a loss per share of 21.3 cents. Market had been expecting a loss of about 32 cents. Clearly, it was a difficult period for them. And I think what disappointed the market somewhat was the fact that they didn't give any guidance for their full year out to the end of March 2023. But having said that, Michael O'Leary did say that they expected to carry about 150 million passengers in the fiscal year, the financial year to the end of March next year. That would be up from 100 million last year, and that compares to about 150 million annual passenger numbers pre-pandemic. So Ryanair is still the leading player in the sector, very strong balance sheet. And I suppose, as always with Ryanair, Michael O'Leary tends to paint a glass half empty type of scenario. And then the next set of quarterly results manages to surprise markets to the upside. So we're very comfortable with Ryanair. James, our analyst, has a price target of €19.44 in it. And we're quite happy to recommend clients to buy Ryanair down around the current level of about €14. That's
great. And finally, we've both been around the block a couple of times.
Thanks.
Mildly. I know I include myself in this. I think, given that we've both seen market downturns, what do you tend to tell your clients when we're in a period of elevated market volatility?
Well, I think history has shown over the years that the longer you stay in the equity market, the better chance you have of getting through periods like this. Equities have traditionally consistently been the outperforming asset class of choice. And be it the great financial crisis back in 2007, 2008, the initial pandemic sell-off back in, in February 2020, markets can take severe legs down. They can experience extreme periods of volatility. But if your portfolio is well balanced and you're in quality names with strong balance sheets, companies and sectors that can withstand whatever volatility is going on within their sectors or the broader economy, those companies will ultimately recover in value. So I'd be recommending to clients, don't panic. Certainly reassess your portfolio to see what changes may be necessary depending on the circumstances. But overall, it comes down to quality and timing in the market.
So there you have it, everybody. Time in the market and don't panic. So many thanks, David. It's always great to hear from you. Our next update will be on the 1st of June. Do please get in touch with your Cantor Fitzgerald broker if you've got any questions or you'd like any further insights. Thank you, and we'll see you again in 2 weeks.